Hello everyone, my name is Vaibhav Puranik and today I'm going to tell you a story of two investors and what they did and how their decisions were not great. So one of the investors bought an investment property in LA, a condo, right? And you know what they did? At that time, it was like 5, 6 years ago, interest rates were like 3%. So they got very cheap debt. And they had this fear of debt, right? We don't want to keep this debt for long over, right? So they got the loan or mortgage for buying that house, but they got it 15 years only. So they amortized it on 15 years. That means that payment went up, right? And their idea was that, all right, let's keep paying, let's keep, let's pay this off in 15 years, and the condo will be completely ours. Makes sense. Some people don't want debt and they want to get rid of it as soon as possible. And it's a good attitude to have. But as a result of that, uh, their property was not cash flow. And they were coughing up money from their pockets for a long, long time until I went in there, convinced them to refinance it to a 30-year debt. Because after a couple of years or so, right, it became unsustainable because they were like coughing up $1,000 from their pocket every single month. And I told them, why would you do that, right? There is no need to do that, right? This cash flow that's coming, the rent that's coming from your property is supporting the 30-year mortgage cash flow. Then why would you have that 15-year mortgage, right? I mean, they were just looking at the total amount of interest they'll pay in 30 years. But what they forgot is that they could deploy their money somewhere else and earn more money from it. Now, a similar thing happened. This is a friend of mine, and what she did is she bought a few condos, multiple condos in Austin, Texas. And she bought it a while ago. Debt was cheap back then, 2-3%, whatever. She was in a hurry. She got a lot of cash and she simply paid that off, all the three condos, free and clear. She owns them now. Or sorry, they were houses, single family houses. She owns them free and clear. Okay, there's no debt on them. She completely paid them off in first 5 years. Now think about this. Now what happens is she owns three condos. There is no debt on it at all. And she has invested all this cash. She basically bought them all cash in a way. If she paid them on first 4 or 5 years, then she bought them all cash. Now the issue is that what is their return, right? Back then the debt was 3%. Right now, even if you put your money in a high yield savings account, no risk at all, you can get 4.5%. This is May of 2026. Inflation is pretty high, 3.8%. And you can get about 4.5% in just high yield savings account. Now imagine if she had that debt with her, right? She had carried on just making payments, not extra payments, just making 3% payments. Whatever extra money that she had, and she had just put it in high yield savings account, she would have gotten 1.5% more than that. That means she could have just financed her, she could have paid off her 3% mortgage and still money would be left for her to spend. Correct? So, fear of debt is real, and some investors, some people, and especially if you're from India, right? Originally from India, you have this fear. You don't want any debts. You want to be free and clear. But you have to understand that certain kinds of debt are good. Of course, credit card debt is really bad. It's 20% debt. Never get it, right? You should always make your credit card payments all the time, on time. But if you're buying a house, investment property, right? That debt is not necessarily bad as long as that debt is uh, paid off by the cash flow. If you have assets that are generating cash and it's okay to take debt on it and continue with it, right? As long as the income that's that generated from the asset is paying off, it's good enough to pay the interest and principal payments. So this is the main topic that I wanted to address: is that uh, not all debts are bad. It's okay to be in debt to buy assets. These assets will generate cash. Not just that, they will appreciate in value. And when you sell these assets, you will get a bunch of money back. All of your debt will get paid off, and you will have way more money left over to enjoy. So please understand, not all debts are bad. Now, I don't plan to give you an investment advice here at all, right? I'm not qualified to do that. All I'm trying to tell you is that just be careful. Don't call all the debts as bad, right? Um, there's a lot of interesting information like this on our website, oldmoneycapital.com. Please visit oldmoneycapital.com. There's a button called Request a Call button. If you click that button, then we will do a call with you and explain you how multifamily syndication works and whether it's something useful for you, right for you, right? There's no obligation at all. We have an Instagram channel as well, Old Money Capital 123. So yeah, let's keep in touch. Thank you very much.